Thank you very much, Mr. Chairman. It's my pleasure to introduce Thala Rolnick, certified public accountant with offices in Arizona. Her practice concentrates on tax planning and compliance for high net worth individuals, partnerships, and closely held businesses. Ms. Rolnick also chairs the IRS Liaison Committee and serves as a member of the Board of Directors for Valley Estate Planners. Thank you for being here.
Thank you. Chairman Walsh and Ranking Member Schrader, thank you for inviting me. As has been said, I've been practicing in Phoenix, Arizona at the estate issues for the last 16 years. The estate tax has been with us since the early Egyptians in 700 BC first initiated. The first U.S. estate tax dates back to 1797. Those in favor say it's an effective tool to raise needed revenue and to prevent the concentration of wealth and power in a few families. Others believe that it discourages capital accumulation and curbs national economic growth. The question with us today is, can a small business survive the estate tax? And the answer is, it depends. The estate tax has been a moving target since 2002, when the amount that could pass estate tax-free first increased from $600,000 per person to the current $5,120,000 per person. At the end of this year, it will drop back to $1 million unless Congress acts. The exclusion amount enacted will determine how many businesses are actually affected. In 2010, when the exclusion amount was $3.5 million, according to IRS statistics, 4,425 small business owners' estates paid some sort of estate tax. This is approximately 0.02% of all business owners. Yet the total estate tax collected was over $69 billion. At a $5 million exclusion, even fewer businesses will be subject to the tax. If the Congress allows the exclusion to revert back to $1 million, based on 2002 numbers, almost 26,000 small businesses will be subject to the tax every year, and now it becomes a very big small business issue. When the current estate law was passed in 2010, it attempted to reduce the need for some of the more complex estate planning techniques. It tried to go ahead and make the exclusion amount more of a family amount by allowing for portability. While the idea was admirable, the legislation is flawed in many ways. First, it only applies to the estate tax and not to the generation skipping tax. So if I want to leave assets to my grandchildren, they will be taxed. Second, to be eligible, the estate must file an estate tax return Form 706. This is very complex and takes a lot of time and energy. The statute of limitations then remains open on this for the life of the surviving spouse. That could be 5, 10, or even 15 years, long after any documentation for how the values were determined are gone. If the surviving spouse remarries, the inherited additional exclusion may be lost. Finally, if the inherited assets increase in value, the surviving spouse's estate may be subject to estate tax that would not have been subject to estate tax had those assets been placed in an irrevocable trust at the time of the first of death. The current code provides favorable provisions for small businesses. Section 2032A provides that land used in a business or a farm can be valued at its current use rather than its highest value. If the land stops being used in this way or sold within 10 years, the additional estate tax is assessed. Section 6166 allows the estate to pay a portion of their estate tax attributable to a farm or closely held business over a 15-year period if the value is greater than 35% of the estate. Section 2057 is currently obsolete, but if the estate reverts back to $1 million, it will become active again. It provides an additional exemption to small business owners, but the calculation cannot be done prior to death and therefore cannot be relied on for during estate planning stages. In addition to the items identified, a number of important estate issues will also expire, and I have those listed in my written testimony. Most business owners are very resourceful and find ways to resolve business issues, but when they don't know what to plan for, planning becomes impossible. There can be no planning until we have some permanence. Therefore, I recommend enactment of a permanent estate and gift tax with an exclusion someplace between $3.5 million and $5 million, adjusted for inflation along with step-up in basis. Permanently rejoin the gift and estate tax. Make portability permanent, but also correct the existing statute to allow a surviving spouse to accumulate up to a full second exclusion. Allow portability for generation skipping tax. Change the statute of limitations for these returns to 3 years. Recommend that the IRS develop a simple Form 707. Preserve reasonable valuation discounts for operating businesses where the death of an owner truly reduces the value of business. Pass a simpler, easier provision to provide small businesses with an additional exclusion. My recommendation is in my written testimony. Pay for these provisions by restoring progressivity to the estate tax at levels above the exclusion amount. Reform the grant-to-retained or annuity trust provisions to disallow excess discounts where the trust holds primarily liquid assets. Thank you for your time, and I'd be glad to answer any questions.